Hey everyone, Scott here, and this week we're going to talk about lazy money and a specific type of product, a specific type of life insurance product that you can use to put some of that lazy money to work so that it works harder for you and you don't have to work quite as hard. That's what it's all about, right? So let's get started. So lazy money, this is money that isn't serving a purpose. We think your money needs to be serving a purpose. So whether that is cash in the bank that's specifically set aside for a specific goal or as an emergency fund, cash is earning nothing, 0.1% or less, but if it's set aside for those specific reasons, emergency fund, a specific goal, that has a purpose, okay? That's not lazy money. That is doing its job, even if it's not earning interest. And then you might have your investments, okay? You might have your foundation, walls, and roof. You might have some investments that are going to provide income, some investments that are going to provide some safety so that everything's not in volatile assets. And then you might have some risk assets up there in the roof earning long-term growth so that we can beat inflation over time, maintain your lifestyle in retirement. So if all those things are taken care of, that money is serving a purpose. That's not lazy money. Lazy money is the 5.5 trillion, not all the 5.5 trillion, but there's $5.5 trillion in cash sitting in bank accounts and money markets and CDs just earning nothing. And that level is way high compared to where we were pre-pandemic. So there's a lot of lazy money out there in the world right now, and we want to help you solve that. So if you have your emergency fund taken care of and your other investments taken care of, and you just need somewhere to park some cash that has been sitting in money markets or CDs or bank account even, then you could use a life insurance product. Now this is actually a new one, because one problem with using life insurance products for this purpose in the past is that your money wasn't always immediately liquid. You know, you'd put the money in and you'd have to wait a few years before you could pull some of the cash value out. Well, there's a new product that actually allows immediate 100% penalty-free liquidity. And so that's a big deal. That is kind of a game changer to where now, let's say you're a 60-year-old, all right? You're a 60-year-old, you're pretty healthy, and you have $100,000 in lazy money that needs to be working harder for you, and you don't smoke, okay? So you're gonna qualify for life insurance. So you can put $100,000 into this product, and you're gonna get some death benefit. Honestly, that's not why we're using the product. It's not a good product for, a death benefit. If you need a death benefit, there's different types of life insurance you should be using. This is maybe going to provide a $180,000 death benefit. So, you put the $100,000 in. If you die the next day, your heirs get $180,000 tax-free. Now, that is an important distinction I need to make. Since it's life insurance, you can't do this inside of an IRA or a Roth IRA. Okay, so this has to be outside of that. But okay, in this scenario, that $100,000 is now, it's going to be allocated to different index options. You could be in a fixed account that's going to earn 2.5% guaranteed, or you could be in a S&P 500 account that's capped at a certain rate, or you could be in a different index that is kind of a blend of different asset classes that's going to have a participation rates, which means you're not going to get, every year they might change that participation rate, and you're going to get a portion or maybe even more than 100% of what that index gets. But if the index drops, you don't lose anything because of that. Now, since it's life insurance, you would have a cost of insurance that comes out. So your balance might go down a little bit. But with this product, remember I said it's liquid, penalty-free withdrawals. There is a little feature in there that we can add that says, okay, after 10 years, if we want to make sure that this thing has earned us something, if the index went down every year, we still want to make sure, we get our money back. We can add that little feature in there so that it offsets all that. So here's the difference between earning 0.1% on $100,000. If you earn 0.1% on $100,000 for 10 years, that $100,000 will be worth a whopping $101,000 after 10 years. Okay, that is lazy money. $1,000 over 10 years, that's not good. So let's say this life insurance product that we're talking about, let's say you're able to earn 3% by using those index options. Well, after 10 years, if you average 3%, that 100,000 will have turned into 134,000, a little over 134,000. It's a big difference. And so that is just an example of putting your money to work. So that's an idea for you. If you have some lazy money sitting out there, which a lot of us do, it's in the news a lot. There's a lot of cash on the sidelines, as they like to say in the news. Then give us a call, 844-CARLSON. Let's see if this life insurance product might be a fit. Give us that call at 844-CARLSON. Set up an appointment with an advisor. Or if you want to see more videos like this, go check us out at carlsonfinancial.com. Up in Carl's Corner, you'll see a bunch of different videos on different topics. And if you enjoyed this video, like and subscribe it for us. That helps us out. And until next time, we will talk to you later. I hope you have a great week, and don't be too lazy with that money.